Hello and welcome to the lecture for Chapter 7. In this chapter, we'll talk about the cost of inventory, how we acquire inventory, how we value it, and then the associated expense account with inventory, which is cost of goods sold. So here we're talking about companies that are providing physical products to customers. So the cost of those products that they sell to the customer, of course, is reflected on their income statement. So I'll talk about both the principles behind it, talk about 4 different costing methods so that you understand those. A little bit about choosing the correct method. I'll talk about lower of cost, or NRV stands for net realizable value. Some people will say lower of cost or market. And then we'll talk about inventory control, and lastly, inventory turnover ratio. So different kinds of companies have different kinds of inventory. So a wholesaler is somebody that sells from one business to another business. So maybe they provide your business with supplies, cleaning supplies, or they supply your business with furniture and computers or that sort of thing. But they're selling a product to another business. A retailer, of course, is somebody that is a business that sells to consumers, sells to end users. Both of those kinds of companies, wholesalers and retailers, they buy their product from someone else. Usually retailers buy from wholesalers and wholesalers buy from manufacturers. And so what they have is merchandise inventory. They have inventory that they don't alter or change in some way. It's a pass-through. Then you have manufacturers, companies that take raw materials and turn those raw materials into products. They take a pile of 2x4s and 2x6s and screws and turn it into a picnic table or whatever the case is. So they're altering the materials in some way. Those kinds of companies will have 3 types of inventory, or 3 stages kind of inventory. One is raw materials. That's how did it come off the truck from our supplier? Sometimes we buy things partially finished, or we may choose that it makes economic sense to buy something in a completely raw form and do the finishing ourselves. It varies by product, but that's raw materials, something we haven't touched yet or altered yet. Work in process is what it sounds like. It's stuff that we're currently working on. It's not raw material anymore because we've started doing some work to it, started adding value, but it's not finished yet. It's not ready to be put in the hands of a customer. Then the last category is finished goods. That is ready to be put in the back of the customer's truck, right? Or in their basket, taken out to their car. That is stuff that is done in all respects. It's packaged, it's completely manufactured, it's inspected, it is done. So here's a little bit of information from your textbook. So in this chapter, we're talking about, from an income statement standpoint, cost of goods sold. A related number that is probably one of the most important numbers in any kind of manufacturer or merchandiser is gross profit. That's net sales minus cost of goods sold gives us gross profit. That's what we need to pay all of our overhead with and provide for profit. So gross profit is important from a dollar standpoint. I'd say it's almost more important from a percentage standpoint. So taking a look at what that gross profit figure is as a percentage of net sales and see if the trend is positive or negative would be a really useful piece of information to have added to this financial statement. On the balance sheet, you see here inventories net. What they mean by net is it's net of any allowance for obsolescence or any allowance for damaged or material to be reworked, and it's all categories of inventory collapsed into one line item. That we would normally have a note in the financials that would then break that out into more detail, either by stage of production or product line or something like that. So here's another way of looking at merchandisers versus manufacturers. So a merchandiser is going to purchase inventory. That is a category or an account in our accounting system called merchandise inventory. It's recorded there at the company's cost to get it to their facility and ready to sell to a customer. So it may include freight in, it may include duties if it's coming from a foreign country, those kinds of things. And then when it's sold, it becomes cost of goods sold. Manufacturers have 3 inputs into the process. They have raw materials that they purchase, that's raw material inventory. Once they start working on it, they add direct labor to it. So that cost flows in as well. That direct labor is people that are directly altering the product. And then we have factory overhead that gets included in our factory as well to the product and work in process. It adds to that cost. So one question students often have is, what is included in factory overhead? Well, it's everything that's needed to make the product that isn't raw material or direct labor. So all of the labor that isn't directly altering the product, like supervisors, inspectors, forklift drivers, receiving clerks, all of those kinds of people that support the process of manufacturing but don't actually alter the product, that's a form of indirect overhead. All of the materials that are not directly visible and able to be traced to the product, like the cost of used sandpaper, or maybe glue or spray adhesive, or things like that that you can't really measure how much is going in each product, that's part of overhead as well. Plus the lights for the factory, the heat for the factory, maybe the rent on the factory, depreciation on the machinery in the factory. All of those kinds of costs, if we weren't making the product, they would go away. That's how you determine what is a factory overhead cost. And as it flows then into those three costs come together in the factory, and then it is fully loaded with those costs when it goes to finished goods inventory. And when it's handed over to a customer, it becomes cost of goods sold. So an important part to think about in both of these kinds of companies, if we have a month where we either buy a lot of inventory or buy inventory and make a lot of product, but we don't have any sales at all of those costs incurred are going to be sitting on our balance sheet, and they won't flow under our income statement until we hand them over to a customer. So the cost of goods sold equation is we take the beginning inventory, in this case $40,000, we add to it the purchases that were made, and this is for a merchandising company. So in that case, we have $95,000 worth of goods that were available to be sold. We're going to take that sum of goods available for sale, and we're going to split it into inventory, which is what's still on the shelf at the end of the month that we can sell in the future. That's a balance sheet. It's an asset we own. And we'll split it into what did we give customers? What drove off our property? We don't have it anymore. That's cost of goods sold on the income statement. So that cost of goods available for sale gets allocated into those two piles based on our calculations. So there are two different ways that companies keep inventory. One is perpetual and the other is periodic. Because the cost of computer programs has come down pretty substantially, most companies now use a perpetual inventory system. What that means is they have, you can think about it in physical terms, a binder of inventory. And in that binder, there is a page for each item that they sell. Whenever they purchase items, they take that binder down, they turn to the appropriate pages, and they add the items that were purchased on each specific page, and they re-subtotal. So at any given point, somebody can call and say how many of X100 product you have. They could turn to that page and say 17 or whatever the case is. Whenever anything is sold, they also take that binder down and they subtract the specific products that were sold and have a new subtotal. So they keep a running balance by item of everything they have. Now, of course, that's usually done in a computer system. So the nice thing about that is because it's done that way, we know with each product that is sold what the cost of those products were. So we can recognize cost of goods sold for every individual sale. The way companies used to do it, and the way I did it when I first started in accounting before those kind of computer systems were available, was periodic inventory, which means you start with your beginning inventory, the value, you add the purchases, you count the inventory at the end of the month, you subtract that, and that tells you what must have left the building, cost of goods sold. So you do it with a physical count every month, and then you have a monthly total for cost of goods sold. Some of the drawbacks of a periodic system: one, it's time consuming because you have to go out and physically count the inventory. Second, you only have a figure about how you did at the end of the month. You can't determine it mid-month or at any intervening time. Another problem is if you have a number that's bad. If you expect your gross profit to be 50% and it's only 45%, that's bad news. Well, now you can't answer the question why. You can't say it was because of this sale that was underpriced or whatever the case is, because you just have one lump sum figure. You don't have individual gross profits by sale. The other problem is you can't determine if something left your building for reasons other than being sold. So was something damaged and thrown away? Was something stolen? Those kinds of things, very difficult to determine in a periodic inventory system. So most companies really should be using a perpetual system if they're not already doing that. So the 4 different inventory flow assumptions. So if we ran, just say, a merchandising business to keep it simple, if we purchased our product from our supplier and we always paid the same exact price for the product we're purchasing, and we always charge the same price to customers when they come in, none of this would matter. It wouldn't matter at all, because what our cost of goods sold would be the cost we pay for everything times that amount. The problem is prices change. Our suppliers charge us different prices. We might buy from different suppliers at different prices. So lots of things can move around. Because of that, if you have inventory sitting in your warehouse and say you have item X100 and it consists of 3 different purchases at 3 different prices, and a customer, you just put some in the back of their truck, you need to ask yourself, well, which priced item did I just put in the back of their truck? What should be the cost of goods sold when I have these units at different prices? In order to answer that question, you need to make an assumption about the flow of inventory. How did it move through the business? You don't have to choose a flow assumption for accounting that equals the physical assumption in reality. I think it gives the best economic picture of what really happened if you choose the actual physical flow, but you don't have to. So the 4 types of flows, and I'll talk about each one in more detail, is specific identification, first in, first out, or we say FIFO for short, last in, first out, which is LIFO, and then weighted average. So specific identification, that can be done with some products where they have unique identifying marks. So most of you realize that every single car has a unique vehicle identification number that's found in various places on the car. That means that I can track my inventory by those unique numbers. When I purchase cars, I can record those unique numbers in inventory with the cost for each one. When I sell a car to somebody, of course, I know which VIN number I sold to them, and I can pull up the exact cost. So there's perfect matching between the cost of the inventory and the sale that is made. So that's the best method. You can maybe do that with fancy art, high-end jewelry, cars, vehicles, boats, in all likelihood. So there are a variety of things that could be done that way, but a lot of products can't. So if you can't use specific identification, then you're talking about kind of how is the flow occurring. The first one here, first in, first out, that means that, and I have pictures of milk here because milk is loaded from behind, you probably know, and you pull from the front. So you're always taking the oldest milk from the front and the back rows are moving forward. So in that case, the customer is getting the first one you put on the shelf is the first one they take. So in cases of inflation, the older units are less expensive, so we're giving customers the less expensive units, keeping the more expensive units in inventory. LIFO is the opposite of that, and I have a picture of a bark pile here. If you've ever been to pick up landscaping bark, you know that they chop up bark and wood waste, that sort of thing, and it is piled up on top. And when you come and pick up, you take off the top. You don't go to the very bottom of the pile. So you're getting the newest, freshest barks that's added to the top. Again, with inflation, you're now going to be getting the more expensive stuff is what we're giving to the customer, and the old stuff that we have down at the bottom at the less expensive price, that's what we're keeping. The last one is weighted average, and that assumes that everything is being mixed up. Each time you make a purchase, you add that purchase to your inventory, you mix it all up, and when customers come and take something, they're taking a mix of that. What you do here is each time you make a purchase, you calculate a new weighted average, meaning cost times the number of components, and there would be layers of inventory. You would add all of those together to come up with a weighted average cost. Now, when we make sales, we need to record for each item what the cost was for that particular sale. So here we have a FIFO assumption with multiple sales through the year. So I'll just walk through this. So we have beginning inventory 100 units at $20 a piece. On February 14th, we go out and buy 200 units, but we pay $21.50 for those units. Now we've got to think of it as 2 layers of inventory. Somebody comes in and buys 220 units from us. Which one of those products are we giving them? Well, because this is FIFO, we're going to give them the oldest stuff first. So you can see we give them all 100 of the $20 items first, and then we give them 120 of the more expensive $21.50 items. So the cost of goods sold figure for that item for that sale is $4,580. When I make that journal entry where I debit accounts receivable, credit sales, debit cost of goods sold, credit inventory, when I debit cost of goods sold, I need to do this to come up with that number. Then I buy more inventory, 160 units, now I pay $22.50. Now I'm back to having 2 layers again, and a customer buys 140. I give them the oldest stuff first, which is the 80 units at $21.50. And then I supplement that because they bought 100 units. I have to give them 20 of the more recent $22.50 units. And you can see how it works on from there, but you can see the basic pattern. And again, we have to do this, or our computer system has to do this, to give us a cost of goods sold figure for each sale. Now, in case of inflation, we're going to find that the cost of goods sold is lower for FIFO than it is for LIFO. So you can see here it's 300 versus 340. So again, the gross profit is higher with FIFO than it is with LIFO, again under conditions of inflation. And the weighted average is always going to be in between the two. So you can see 320 is halfway between 300 and 340. That's one of the reasons that I liked weighted average the best when I did this kind of work. There's really 2 reasons. One, it kind of took away some of the peaks and valleys and smoothed things out a bit by using average, especially in times of inflation. So I preferred it for that reason. The other reason I liked it was it made more intuitive sense when you explained it to people that aren't accountants. If you start throwing around terms like FIFO and LIFO in a meeting with other non-accountant people, they think you're pulling a fast one. So the next topic is lower of cost or market. And this is kind of separate from the assumptions about flow. So we do that, that's fine. But then we look at what the cost of the inventory is by item versus the market value. And sometimes we'll use the term net realizable value because we might need to incur some costs to get it sold. So we might look at the net amount we would get after that. So if the market value has fallen to a point where it's less than the cost that we have it on our books at, we need to write it down and recognize an expense at that point because we know that we're going to lose money when we sell that particular product. So the minute we know that, we should recognize it to be conservative. We can do that for individual items, which is the way it's usually done. That's the most conservative way to do it. Or you can class items and do it in total, or you could do it as the inventory as a whole, which is the least conservative way. So here's a diagram of how to do that math. So we have 4 different items in inventory with 4 different quantities. Each item, we look at the unit cost and we look at the market value. So we multiply or extend out the total cost for each item. We extend out the total market value for each item. And in this case, they did it by item, not in total. So we look for each line item. For item A, the lower of the 2 figures is cost. For item B, the lower of the 2 figures is market, and so forth. So I add up that last column, lower cost or market, and I see that my value of inventory should be $28,410. Right now it's $30,020. So I need to make an adjusting journal entry based on this information to recognize cost of goods sold, and so to debit cost of goods sold and credit inventory for the difference between those two figures so that I end up with that lower balance. Control of inventory is really important. So it is something that can get stolen. Fraud can take place relative to inventory, that sort of thing. So some things that are important to keep in mind. One, it's important to have a separation of responsibilities for taking care of inventory, physically handling it. So the person that orders it shouldn't also receive it. They shouldn't also pay the invoice for it being due. The person that enters an order from a customer shouldn't be the one that picks the items and ships them. Those should all be done by separate people. That way that if you're going to be doing something squirrely, paying for phantom goods that don't come in, or shipping product to yourself at zero price so you can resell it, those kinds of things, if you have multiple people involved, then that requires collusion, which is a bit more rare. We need to store inventory in a manner that protects it from being stolen. So locking doors and security, and people should only be in spaces they have need to be in, that sort of thing. Limiting access to inventory to only authorized people, so everybody shouldn't be there roaming around. Maintaining perpetual inventory records, so we talked about that earlier. That allows you to go and do cycle counts, which is the last item, comparing perpetual records to physical counts. So in my company, we would do a full inventory count at year end, but every single week during the year, we would do cycle counts, and we would strategically select items that we would go out and count these 10 items. And then we would adjust our inventory. We would usually research why there was a difference and then adjust the inventory. So you're always keeping your inventory records correct. The thing that's nice about doing that is if you continually see a particular item, your system says you have more than you physically have. That may be an indication that something is being stolen, and you can add a security camera, or you can do something to prevent that from happening going forward, rather than waiting till the end of the year and then that's kind of too late. So sometimes people do make errors on year-end inventory. That happens even with the best of intentions. And it will create a loss in one year and a gain in the next year if we undercount inventory. So let's say we go out to our warehouse and we forget to count the top rack on the warehouse racking. So we come in and say, well, the system says we have $1 million worth of inventory, but we only counted 900,000. We would take a loss of $100,000 in that case. It's as if the inventory were stolen. The entry we'd have to make was debit cost of goods sold, or debit some kind of expense, and credit inventory. So that's frustrating. Well, the next year, we adjust our records then. Well, the next year we count and we find that inventory on the top rack. And so now we get to debit inventory and credit cost of goods sold. We reverse the impact of that $100,000 pain we experienced the previous year. So that can happen, and understand that it's a timing difference. And we should do everything we can to make sure that year-end inventory is correct so we don't introduce errors into the reporting. So inventory turnover is kind of, this should look familiar from the last chapter when we talked about accounts receivable turnover. So inventory turnover is also a really valuable thing to calculate. If a profitable growing company is having cash flow problems, it is usually because they're accumulating too much in the way of receivables or too much in the way of inventory, and their cash is being hung up in those two buckets. And so calculating both the accounts receivable turnover and the inventory turnover can help us identify where the problem is so that we can focus on fixing it. So inventory turnover, we take cost of goods sold and divide it by average inventory. It could be a simple average like you see here. It could be 12 months divided by 12. That'll tell us how many turns there are. Again, that's not a super intuitive number. You could divide that by 365, and that would tell you the number of days you had a particular item in inventory. That's a better way to do it in my view, similar to how we did accounts receivable. So again, the benefit here is you don't have a policy to compare it to like we did with net 30 terms with accounts receivable, but you can at least see what the trend is, and is whatever you're doing about it requiring lower inventory purchases, or whatever the case is, shorter production runs, things like that, you can see if it's making a difference. Last item is how to estimate an inventory when you can't physically count it. So maybe there was a fire or a theft or something like that, and to file an insurance claim, you need to come up with what the ending inventory balance is. So in this case here, you have to really be careful about not mixing the sale price with the cost of the item. Yeah, and that's why we've got a couple columns there. So we start with beginning inventory, and then we have purchases through the date that we had the loss. So I know how much was available for sale. In this case, $23,600 at cost was available to be sold. I know that my sales through that period this year were $22,000. Now again, that number is at the price I'm charging customers, not at the cost I'm paying for it. So I need to convert that figure from a sale price to a cost. So I can do that by subtracting the estimated gross margin. So in this case, the company's gross margin was 25%. So I could take 22,000 minus 25%, which is 5,500. That would give me cost of goods sold of 16,500. So of that 23,600 that was available to be sold at the date of the fire, 16,500 would have left during the year. So what I should have left is $7,100. So that is what I could file my claim for. So please work through the 3 in-class practices before you start on your homework. And as always, if you have questions, don't hesitate to send me an email. Thank you.